Hello everyone, welcome back to my YouTube channel and I hope all of you are doing great. So in today's video, we'll be looking at limiting the downside or how you can limit your downside in the bear market or how you can handle the bear market. So let's get started with the video. Standard disclaimer first, I'm not a SEBI registered analyst and any stock discussed in this video is not a buy or sell recommendation. Please consult your financial advisor before taking any trade or making any investment. So let's start with the basics first. Right. So the basic principle of the market is that it's always trending. For a period, it's in an uptrend, then it goes in a downtrend, then the phases of choppy market or the choppy activity in between is called the sideways market. Right. So that is the core principle of the market. That is the basics that the market is trending. It's either in an uptrend when everything is going up, or sometimes it's in a downtrend when everything is going down. And then there are phases when nothing is happening and the market just goes like this. There are phases of ups and downs. That is called the sideways market. Right. So what we think basically is that this is the phase we all want to be in. That is the uptrend. And this is the phase we all want to avoid. And in between, we have a phase called the sideways that we cannot avoid. For some reasons, we cannot avoid. Right. So have you ever thought about where do people lose most amount of money? Right. So uh, in general, like the first thought that comes in my mind is that people lose money in a downtrend, right? So people lose most amount of money in a downtrend, right? So that is the basic core principle, right? But have you ever thought, right, what you do in this phase, that is the sideways phase, can determine if you are going to lose money or if you are going to save the money, right? Let me explain why. So as I said, the market moves in a cycles, right? Market moves in cycles. There are uptrend, downtrend, and there are phases of sideways or no activity, or you can call it a distribution, or sometimes even consolidation, right? So what happens is that when the market is transitioning from an uptrend to a downtrend, there's a phase, that's the sideways phase, when that transition is happening, right? So that is the phase that will determine how you are going to perform after this, after the sideways wave that is in a downtrend. And why is that? Because first of all, when the market is going up, everything is euphoric. Like everything seems so easy, making money seems so easy, there are stories being written, right? Everything is going up and it looks like you, like nobody can perform better than you, right? Then comes the sideways phase where the things get a little bit choppy, right? So sometimes you make money there, sometimes you lose money there, and it's like a phase of death by thousand cuts, right? Because a lot of small losses accumulate in this phase, right? And another thing that happens in the sideways phase is that you try to capture it because we have a inherent hope, because we have a bias, when the market is when the market was going up, when the market was in an uptrend, we have a bias that things may improve further from this, because we have seen many consolidations like these happening during the uptrend phase as well, right? So we have a hope that the market goes like this, and we can just accumulate, we are getting the stocks at lower prices, and the market will continue to go up after this, right? So in that phase, what we do is that we get in and out a lot, especially the traders get in and out a lot, right? And the tragedy happens here is that by the time you get in fully, right, by the time you get the signal that it's okay to go in fully, you are here in the sideways phase. After a small up move, you are here, and when you are fully invested at that point, most of the time what happens is that the market goes like this after that, and then again the same story repeats for some time. And that is what we have seen, that has been happening from last few months, right? Because the market goes up, comes down, goes up, comes down, goes up, comes down, right? So by the time we are fully invested, the market is about to turn again, right? So that is a difficult phase, and unless you are really good at timing the market, that is, you're really good at intraday, or for a very short term kind of a trade, it is extremely hard for normal people to manage the trades in a phase like this. So it's a really good idea for us to avoid this phase. So what happens is that when that particular transition is happening, when everything was euphoric, what happens is that people tend to get too much optimistic, right? So in this phase, people get too much optimistic, and they forget that there's a downside as well. They think just the market will continue because there's a lot of storification. If you must have, if you know, if you have seen today's storification, you if you have seen what happened in case of data center stocks, what has happened in case of solar manufacturing stocks, right? So you must be aware what kind of storification goes on, right? So people who are not very aware, people who are relatively new in the market, tend to get stuck in these phases, and then they'll have to face this downside. So what happens is that you're stuck in these particular stock, and suddenly the market dives. So you had a loss of 10%, now it's 15%, 20%, 25%, and now it's impossible to get out, and you get stuck in this. So that's why I say is that the most amount of money is lost when you're not able to manage and take the right steps during this phase of the market. That is the sideways phase, or the transitioning phase from an uptrend to a downtrend. So generally a market, if we talk about in technical terms, right, a market is considered a bear market when the prices have declined more than 20%. But if you look at the chart, this is the mid cap 150 index, I think so, and it has declined only 15%. So technically it's not a bear market, right? That is what this definition says. But that is only the technical definition, and it's not the whole truth. That's why I say that indices don't show the complete truth. Because what happens is that indices have weightage of different stocks. So it's a basket of stocks, and there also few stocks will have higher weightage. So in case those stocks are performing relatively better as compared to the overall market, your index will perform better, right? And that gives the false illusion that only the index has fallen only 15%, so it's not a bear market, and it's not that bad. But if you go deeper and look at the sectors, majority of them are down more than 25% from their 52-week highs. So if you look at the sectors like microfinance, the whole sector itself is down more than 50%. And individual stocks like the Arman Finance is down, I think so, 44%. If you look at stocks like Fusion Microfinance, those stocks are down more than 70% from the top. Just imagine the wealth erosion happening there. And even the winning sectors, the best performing sectors of last 2 3 years, like the railways or the telecom or the PSUs or the solar panel manufacturers and even the transformers. These were the leading sectors of last few years, last 2 3 years. The rally has happened in these sectors, and people tend to have a bias towards the sectors that have performed really well in the recent times. So people who missed the rally, that particular rally, right? So most of them try to get in at a point where the price is declining a bit because they think they are getting it at a cheaper rate. But what happens is that the steam has left, you know the train has left the train has already left the station. The whole steam is gone. The whole storification has happened. Everything has been done. The money has been made, and now it's time to dump that particular stock or those particular sectors. That is where the newbies, the new people who are new in the market, get stuck, right? So it's always a good idea to look at the sectors, how they have performed in the past, and uh, what they are doing currently. So it's not a good idea to jump in when they're if a star sector is currently down. It's not a good idea unless it start going up again. And learning from the past. So this is the best step that we have, learnings from the past. So this is the chart of small cap 100 index and the phase of 2018 to 2020, right? So why I'm saying this learning from the past is that another thing and another mistake that people make, especially the short-term traders, the swing traders, like traders like you and me, is that when the market has been continuously going down for few days and there's a bounce, and there's always a bounce because market never stays in a single direction for too long, right? So there's a bounce. People tend to get again too euphoric in that, too optimistic, too euphoric in that phase, right? If you look at the 2 days bounce, so many people will, on social media you'll see many people will start jumping in that I'm going in 100%, I'm going in 150%, and so on, right? They're jumping in immediately. But even in a bear market, in a complete bear market, there are counter trend rallies that happen. There are sideways market that happens. The stocks can go up like 10, 20, 25% in a bear market as well. But you have to be very good at timing those stocks, timing those opportunities, right? Because because see, it's like market never stays in a single direction for too long. So there are counter trend rallies that happens when the things are too oversold. There are counter trend rallies and you can get good opportunities there, but you have to be good at it. And most people who are not good at it, it's better to stay away. It's better to let the market form a base, let the uptrend start again, right? Because what people try to do is that, let me show you with a live example. If you just look at the index, the current index, the mid cap, if you just look at the mid cap index, so what, you just have to zoom out a bit, right? You just have to zoom out a bit, right? So what most people try to do in these phases is that they try to capture here, this point. They try to capture these points, right? Okay, the market has declined a lot and now it will only go up and all of that. But you don't know if it's going to be like this or it's going to be like this. You don't know that, right? So why take the unnecessary risk of predicting what's happening? Like, what's the worst that could happen if you get in somewhere around here when the uptrend is confirmed, right? You're using just only this, right? You are only losing this amount of money, this amount, whatever you would have made in that phase. And that is, trust me, it's not too much, especially when the market is fresh in an uptrend. It's generally not a time where you'll make a lot of money. The most amount of money is made when the market is in a full euphoric phase, right? And then comes the phase again where the market goes in a sideways or in a downtrend, right? So that is the time where you have to be careful. You have to manage your expectations. You have to be careful. You have to take lesser number of trades. You have to save the money that you have earned in this particular phase, because it's not necessary to trade every single day. It's not necessary. If you didn't make money today, so you won't be able to make money tomorrow. It's just, best practice here is that you just have to observe. You have to wait for the right opportunities, right time, according to your style. Unless you're really good at intradays, you can do intradays. But if you're not good at intradays, it's better to stay away. It's better to sit on the sidelines and wait for the market to set up again. You won't be becoming billionaires or the millionaires or whatever you're thinking from these counter trend rallies of 5-10%. So it's better to manage your expectations. It's better to take a step back and observe things. So that is it for today's video. This is all I wanted to say, right? So you need to learn how to manage your expectations of the market, from the market. That is all for today. Goodbye, take care, and I'll see you in the next